At 8:01 in the morning on the 1st of August, 2012, a computer inside Knight Capital sent an internal message naming, in plain text, the exact cause of the firm's death. It sent that message 97 times before the opening bell. There was no one whose job it was to read it. Knight Capital was the largest retail market maker in the United States. Roughly 1 in 10 shares traded on American exchanges passed through its systems, and firms including Scottrade, TD Ameritrade, E-Trade, and Vanguard routed customer orders to it. Knight was not an agency broker collecting a commission on someone else's risk. It was a principal. Every execution its machines produced put real stock on Knight's own balance sheet, at Knight's own price, funded with Knight's own capital. The immediate cause was competitive. The New York Stock Exchange had built a retail liquidity program, the venue itself bidding for the retail price improvement that was Knight's core franchise, and it was going live on the 1st of August. Knight's answer to being disintermediated was to join in, which left it roughly a month to write, test, and ship new routing code. The deadline was not negotiable because the deadline belonged to the exchange. That code went into SMARS, Knight's Smart Market Access Routing System. SMARS took a parent order from a client and sliced it into child orders routed out to trading venues. A cumulative quantity counter tracked shares filled against the parent size and told the router when the parent was complete and the slicing should stop. That counter is the only thing standing between an order router and an infinite loop. Inside SMARS sat legacy functionality called Power Peg. Knight stopped using it in 2003. It was not deleted, and it was not disabled. It remained in the production codebase, gated behind a single configuration flag, still fully callable 9 years later. 2 years later, in 2005, Knight moved the cumulative quantity function to an earlier point in the routing sequence. That change took the counter out of the Power Peg path, and Power Peg was never retested afterwards because nobody was using it. From that day forward, the firm carried, in live production, an order generator with no working stop condition. It was harmless for 7 years only because nothing ever called it. In July 2012, the engineer writing the Retail Liquidity Program code reused the configuration flag that had once switched Power Peg on. That reuse was ordinary engineering. The flag was free because Power Peg was retired. But it meant that on any machine running the new software, the flag meant retail liquidity, and on any machine running the old software, the identical flag still meant Power Peg. 1 bit. 2 mutually incompatible meanings. Distinguishable only by which version of the code happened to be resident on the box. Deployment began on the 27th of July, staged manually over several days across Knight's 8 SMARS servers. 1 technician did the copying. No second technician reviewed the work, because Knight had no written procedure requiring anyone to. 7 servers received the new code. The 8th did not, and nobody noticed that the old Power Peg code was still sitting on it. This is the part that generalizes beyond finance. 7 out of 8 is a worse outcome than 0 out of 8. A total deployment failure announces itself in seconds. A partial one produces a machine that behaves correctly for almost all traffic and catastrophically for the small slice carrying the flag, which is precisely the failure mode no monitoring system is looking for. At 8:01 that morning, pre-market orders carrying the repurposed flag reached the 8th server. An internal Knight system began emitting automated messages referencing SMARS with the error text Power Peg disabled. Between 8:01 and the 9:30 open, 97 of those messages went to a group of Knight personnel, roughly one every 56 seconds. Knight had never designed those messages to function as alerts, and staff did not generally review them. This is not a story about people who ignored a klaxon. It is a story about a firm that had no channel capable of separating routine reject traffic from the sentence your router has lost its fill counter. The machine diagnosed itself correctly, by name, 90 minutes early, into a mailbox nobody was obliged to open. At 9:30 the market opened, and 212 ordinary parent orders were routed with the repurposed flag. On the 8th server, Power Peg fired. With the counter out of the path, SMARS never learned that the parents had been filled. Upstream systems could see the fills, but that information was never fed back to the router. It kept slicing. Millions of child orders against 212 parents. Knight was not losing on a directional bet. Reconstructions of the tape show the signature, buying at the offer, then almost immediately selling at the bid, then buying at the offer again in 100 share lots, evenly spaced in time. In one large utility name, that round trip cost roughly 15 cents a pair. The spread was the weapon, and no market move was required to make it lethal, only frequency. In approximately 45 minutes, SMARS obtained more than 4 million executions in 154 stocks, covering more than 397 million shares. Knight ended up long about $3.5 billion across 80 stocks and short about $3.15 billion across 74. Call it roughly $7 billion of gross equity exposure, assembled by accident, by a firm whose cash on hand was measured in the hundreds of millions. Then Knight's own response inverted the problem. Unable to locate the fault under live market pressure, technologists uninstalled the new Retail Liquidity Program code from the 7 servers where it had deployed correctly. Removing the new code restored the old meaning of the flag on those machines, and Power Peg activated across the fleet. They had correctly identified the new code as the change, and incorrectly identified it as the fault. It was the absence of that code that was killing them. The fix was the accelerant. The common line is that Knight had no kill switch. The precise version is worse. A human could shut SMARS down, and eventually one did, but the switch was all or nothing, and pulling it meant severing every customer's order flow at once, so there was reluctance to touch it. What did not exist was any automated trip. No preset firm-wide capital threshold wired to block order entry. No check comparing orders leaving the router against orders entering it. No procedure to halt SMARS in response to its own output. The switch existed. The automatic trip did not. And this was not the firm's first encounter with the difference between test state and production state. In October 2011, Knight ran a weekend disaster recovery exercise using test data, then continued using that test data to generate live automated quotes when trading opened on Monday. It cost roughly $7.5 million. 10 months before the 1st of August, Knight had already demonstrated the exact failure class and shipped no control in response. That is why this is an autopsy and not an accident report. Now the market structure chain that turned a trading loss into a solvency event. After the flash crash of 2010, the clearly erroneous execution rules were deliberately narrowed so that participants could rely on printed trades. Trades break only when prices move far outside wide bands. Almost all of Knight's damage occurred inside those bands because the spread bleed mechanism produced small errors at enormous frequency. Exchanges canceled trades in only a handful of the most extreme names. The rest stood, and Knight owned every one of them. Under the settlement conventions of the time, Wednesday's trades settled the following Monday. Knight had 3 business days to either fund several $1 billion of purchases or eliminate the positions. Layered on top of that, the regulatory capital charge on a multi-billion-dollar unhedged equity book would have prevented Knight from opening for business the next morning. The trading loss was already fatal by Wednesday afternoon. The settlement calendar just set the execution date. Knight could not work that book out through the tape. Doing so would have been front-run into the ground and would have recreated the very price impact that produced the loss. So overnight it canvassed the street and sold the portfolio in blocks to rivals, Goldman Sachs reportedly taking the bulk at a discount of about 5%. That discount was not a fee. It was the price of being a publicly known forced seller with a deadline. Then came the run, and a dealer run is faster than a bank run, because the depositors are algorithms that can repoint a route in milliseconds. Within a day, major clients including TD Ameritrade, Scottrade, E-Trade, and Vanguard had stopped sending orders to Knight. For a market maker, order flow is the revenue. Nobody routes a customer's trade to a firm that may not be able to settle it. On the 6th of August, 4 business days after the open, Knight sold 400,000 shares of convertible preferred stock for $400 million to a syndicate of 9 investors, among them Jefferies, Blackstone, TD Ameritrade, Stifel, Stevens, and a direct competitor named GETCO. Conversion was struck at $1.50 a share, into roughly 267 million common shares, around 70% of the company. Knight invoked the exchange's financial viability exception, so existing shareholders got no vote on their own dilution. The rescue, not the loss, is what took the firm from its owners. Note the sequence carefully. Knight's shares fell about a third on the 1st of August, and again far harder on the 2nd, roughly 75% of the equity's market value erased in 2 sessions. On the 19th of December, GETCO, a rescuer 4 months earlier, agreed to combine with Knight in a deal valued near $1.4 billion, with Knight holders electing roughly $3.75 a share in cash or stock in a new holding company. It closed in July 2013 as KCG Holdings, with GETCO's chief executive running it. Virtu bought what was left in 2017. The Knight name is gone. On the 16th of October, 2013, the Securities and Exchange Commission censured Knight Capital Americas and imposed a $12 million penalty, the first enforcement action ever brought under the market access rule. The findings were not about the money Knight lost. That was Knight's own problem. They were about absent controls. No automated capital thresholds, no pre-submission erroneous order checks, no technology governance to prevent activation of retired code, no incident response procedures, mismarked and unlocated short sales, and an annual certification that attested the firm had processes rather than that its controls actually complied. No individual was charged. The rule Knight violated had been on the books since 2010, with compliance mandatory from July 2011, a full year before the event. What followed was Regulation SCI, adopted in 2014, which landed on exchanges and infrastructure rather than on broker-dealers. So the reform was not really a new rule. It was the decision to finally enforce the old one. Here is the trader's read. Knight was not killed by a bug. Every line of that code did exactly what it was written to do. It was killed by an interaction between 2 decisions 7 years apart, neither wrong on its own, inside a firm that had removed every automated governor between order generation and inventory accumulation. A principle that cannot bound its own inventory does not have a technology problem. It has a balance sheet pointed at the market with the safety off.